Now let's talk about the case study on a very easy chapter, that is leverages. One of the most easiest chapters of financial management, as you all know. And because it's an easy chapter, the case study is also going to be easy, obviously, sir. Let's see. Best Limited, a prominent company in the semiconductors industry, aims to understand the impact of operating and combined leverage on its financial performance for the year ended 31st of March 2024. By examining the provided financial details, the company seeks to make the informed decision regarding its cost structure and financing mix. Best Limited is a well-established firm known for its products in the market. With a focus on innovation and customer satisfaction, the company has achieved significant growth rate and success over the years. So this is what? This is about the company that they are telling that what this company is doing, what is the profile of the company, not relevant to us as such for the calculation purposes, as you all know. Right. Next, the fixed cost excluding the interest is 2040. That means this is which fixed cost? This is your fixed operating cost. This is your fixed operating cost. Next, sales are given 30,000 lakhs, 12% debentures of rupees 100 each, rupees 21,250 lakhs, equity share capital of rupees 10 each, rupees 17,000 lakhs. Now, one thing that you have to be careful about here is that whenever the equity share capital is given to you, you have to see that whether this equity share capital is given in rupees or whether it is given in the number of equity shares and what is the price of each share. So this is where you need to be little bit careful about with regard to the equity shares, the preference shares and the debentures, right? So be careful with this thing. Income tax rate is given as 30%. Mr. Pallav Kumar, an executive director from the engineering background, discussed the following analysis with CA Nagarjuna, additional director finance of the company. Okay, the operating leverage. Now they are telling something about operating leverage, then about something about the combined leverage. They say operating leverage, which is currently at 1.4. So this is the value of operating leverage that is given to you, that is 1.4. Measures the impact of fixed cost on the company's operating income. Operating income is the EBIT, right? The impact of fixed cost on EBIT. Combined leverage considers both the operating and the financial leverage. It is calculated as the product of operating leverage and financial leverage that we know, sir, right? And the company's combined leverage is 2.8. So this is the combined leverage that is given to you. Next, they say CA Nagarjuna explained to Mr. Pallav Kumar that the finance department is already analyzing the various leverages like the operating leverage, financial leverage and the combined leverage. Due to these, the Best Limited gains the insight into its cost structure and financial risk. Okay, these information enables the company to make strategic decisions regarding its operating expenses, financing options and the overall business strategy. Continuous monitoring and evaluation of the leverage ratios will be essential for Best Limited to maintain the financial stability and drive sustainable growth in the competitive market landscape. So this is again nothing but it is a story that is there, right? It is just a story which is not relevant for our calculations. What is relevant for our calculations is this part is relevant, that what is your operating leverage, what is your combined leverage, then this part will have a role to play, this much. Rest everything is what? Rest everything is a story, right? So in the case studies you will get a certain stories, but you have to be careful. You have to keep in mind that what is that thing, what are the information that is relevant for us. Mark that information that okay, this much information is relevant for us in the examination, right? Let's see what they are asking for. Calculate the financial leverage. Very easy, sir. How can you calculate financial leverage? That is combined leverage divided by operating leverage. Now combined leverage is given as 2.8. Operating leverage as 1.4. So it will be 2.8 divided by 1.4. So that comes to option B, that is 2. Is that clear? Second, they are asking for the profit volume ratio, that is PV ratio. Now for PV ratio, what you need? For PV ratio, one thing that you need is contribution divided by sales multiplied by 100. So this is what you need. The sales are given in the question itself. The sales are given as how much? The sales are given as 30,000 lakhs. But what you need to calculate? Contribution. How can we calculate contribution here? Can we make use of operating leverage? Now operating leverage is given as what? 1.4. What is operating leverage? Operating leverage is written as contribution divided by EBIT is equal to 1.4, isn't it? Now, can I write this EBIT as, can I change this to contribution? Can I write EBIT as contribution minus fixed operating cost? Yes or no? Yes, sir. And the fixed operating cost is given in the question. I have already written, that is 2040. So from here we can find out the contribution. So from here what you will write? You will write contribution divided by contribution minus fixed operating cost of 2040 is equal to 1.4. Right. So from here the value of contribution that you will get, what will be the value of contribution that you will get? The value of contribution will be 7140. This will be the contribution that you will get. Right. Try to solve. After solving it, you will get this contribution value of 7,140 lakhs. Now we can calculate what? Now we can calculate our PV ratio, that is 7140 contribution divided by sales of 30,000 multiplied by 100. So 7140 divided by 30,000 multiplied by 100, that comes to 23.8%. 23.8%. That means we have option C with us for the profit volume ratio or the PV ratio. Is that clear, everyone? Very easy. This case study is one of the easiest case studies that you will come across, right? So leverage is done, contribution, PV ratio we have calculated. Fine. Now next they are asking for the EPS, that is the earnings per share. Now for earnings per share, you should immediately one thing that should strike your mind is, from where do you get the EPS? Income statement. So prepare the income statement. Very simple. You have to just prepare what? You have to prepare the income statement. Start from where? Start from contribution. We have just calculated the contribution. Contribution as 7140. From that contribution, subtract your fixed cost. Fixed cost is given as what? This is your fixed operating cost, that is 2040. So this will give you the EBIT of 5100. From this EBIT, you will subtract your interest on debt. Interest on debt. What will be the interest on debt here? That is 12% on 21,250. 12% of that will give you 2550. That will be your interest on debt amount. 2550. So you will get here what? 5100 minus 2550, that is 2550 itself. This will be your EBT. On EBT, you will pay your taxes. What is the tax rate that is given? We'll have to see. Tax rate is given as 30% here. Right? 30% is the tax rate. Tax at the rate of 30%. So that will come to 765. That will give you EAT. Earnings after taxes, that is 1785. Is there any preference shares which are given? Because from the EAT, what you do is, from EAT normally you pay preference dividend first. But in this capital structure, there is no preference dividend. That means nothing to be paid. This is EAT is what? This EAT becomes your residual earnings also. That is the earnings available for equity shareholders divided by number of equity shares. How many equity shares are there? See, 17,000 lakhs divided by 10. So it will be 1700 equity shares. So this will give you EPS. So 1785 divided by 1700, this will give you the EPS of 1.05. That means the option B that we have. So whenever they are asking for EPS or anything, the first thing that should come to your mind is the income statement. That by any means we can prepare the income statement. That means we will be able to find out EPS. Income statement might start from sales. Sales minus variable cost, contribution minus fixed operating cost, EBIT minus interest, EBT minus tax, EAT minus preference dividend, residual earnings divided by number of shares, EPS. Or it might start from contribution or EBIT like in this particular case. Right? So income statement is one of the key areas, I tell you. Income statement is one of the key areas. Okay, next, calculate the asset turnover ratio. Now, what is an asset turnover ratio? Asset turnover ratio is sales divided by total assets. right? What is the value of sales? The value of sales is given 30,000, but how will you find out the total assets now from here? What will be the value of your total assets? They say the total assets here will be the total of debentures and equity share capital, assuming that there are no current liabilities. So this is your total liabilities. This is your total of your liability side, and total liabilities will be equal to your total assets, right? So total assets here will be sum total of debentures and equity share capital, that is 21,250 plus 17,000, that comes to 38,250. That comes to 38,250. So this is 30,000 divided by 38,250, that comes to 0.784. Option C, this will be your asset turnover ratio, right? Sales divided by total assets. Now next, calculate the minimum level of sales which must be attained to at least pay the finance cost of Best Limited. Very good part. This is an important part. This is an important MCQ. They say how much of the sales will be required which will be sufficient to just pay the finance cost. Just pay the finance cost means what will be the EBIT, which is just sufficient to pay your interest on debt. If it is just sufficient to pay your interest on debt, that means your EBT will be what? EBT will be 0. If EBT will be 0, that means your EPS will be 0. Isn't it? Your EPS will be 0, just sufficient to pay. So we can say here that EBT will be equal to 0. If EBT is 0, the EPS will also be 0. Now the current EPS is 1.05. If you say there is a fall in the EPS from 1.05 to 0, can you tell me what will be the percentage change in the EPS? What will be the percentage change in the EPS? That will be 100%. That will be 100%. Now combined leverage is given, that is 2.8. Isn't it? What is combined leverage? Combined leverage is percentage change in EPS due to percentage change in sales. This is how we read it. Combined leverage is given as, this is given as 2.8. Percentage change in EPS is 100 divided by percentage change in sales is equal to 2.8. So what will be your percentage change in sales? That will be 100 divided by 2.8. 100 divided by 2.8, that comes to 35.714%. 35.714%. That means now the sales from the existing level is to be reduced by 35.71%. 35.714%. The sales need to be reduced. Sir, why reduced? Why not increased here? The EPS is reducing, EBT is reducing. When will the EPS reduce? Only if the sales will reduce. That is why when we covered leverages, we use this sign. When we use this sign here, we use the word change, not increase or decrease. We use the word here what? We use the word change. Change here means it might increase also or it might decrease also. The change includes both the changes, increase and decrease. And in this case, the EPS is reducing from 1.05 to 0. That means your sales will also reduce. So what will be your revised sales here now? What will be your revised sales? That will be the existing sales of 30,000 lakhs minus 35.714% of this sales, minus 35.714, sorry, 30,000 minus 35.714%, that comes to roughly 19,286 lakhs. So this will be your revised sale, or we can say the minimum sale which is required, which is just sufficient to pay my interest on debt, that is my finance cost. When he's talking about, see, it is very important that you should know the small terminologies. Finance cost means here what? The finance cost here means the interest on debt. He's not talking about the operating cost. There is a difference between operating cost and the finance cost. Finance cost here means the interest on debt, and if there is any preference dividend, that is what we call it as financial fixed cost. right? This is what we see. The terminologies are going to be important, because only then you will be able to interpret these things, right? You will be able to interpret these things only if you know the terminologies, what they are asking for. Sarji, they are asking for the finance cost. What is a finance cost? If you don't know what is a finance cost, how will you interpret that? What is a finance cost, right? You might take it as the fixed operating cost. Clear? So each and every small terminology is going to play a very important role, right? So with this, we are done with the case study on the chapter leverages, which was very, very easy. Please go through it once again before moving on to the next one. Now let's discuss about the case study on cost of capital. Interesting, easy case study, and this is a kind of a case study which can be asked in the examination. Let's read it and try to interpret it. MNP Limited is a multinational company having its operations spread mostly in India and neighboring countries of India. The promoters of the company believed that the capital structure of the company must be kept flexible and balanced with where the proper mix should always be maintained between debt and equity. Such mix of debt and equity should be reviewed from time to time, keeping in mind the changing situations of India and the global scenario. So there is just nothing, just a simple basic information that what the companies, the directors and all they want. That's it. The capital structure of MNP Limited is as under: 9% debentures rupees 2,75,000, 11% preference shares rupees 2,25,000, equity shares face value rupees 10 per share 5 lakh. Okay, rupees 5 lakh equity shares. So wherever the equity shares are there, you have to be very careful with one thing, whether it is the number of shares which is given or whether it is the rupee value of the shares which is given, right? So that means here you will have how many shares? Here you will have 50,000 shares, right? Total capital of the company 10 lakh rupees. The following are some of the additional information provided by MNP Limited. Rupees 100 per debenture, redeemable at par, has 2% flotation cost and 10 years to the maturity. The market price of the debenture is 105. Right? That means if I want to calculate that what will be the number of debentures here, if I want to calculate the number of debentures, rupees 100 is the face value. So that means my number of debentures will be 2750 debentures. Correct? Second thing, whether these are redeemable debentures or whether these are irredeemable debentures. So these are redeemable debentures. So that means when we have to calculate KD, this information is given for the calculation of KD. When we have to calculate KD, we will be thinking from the viewpoint of redeemable debentures. That means either the approximation method or the YTM method to be applicable. Okay, fine, sir. Next, rupees 100 per preference share redeemable at par has 3% flotation cost and 10 years to maturity. Again, redeemable preference shares. That means when we will calculate KP, these will be the redeemable preference shares. The market price per preference share is 106. Okay. Now again the face value of preference share is 100 rupees. So here if I ask you that what will be the number of preference shares, what will be the number of preference shares? That will be 2250. This will be the number of preference shares. Next he says the equity shares as rupees 4 flotation cost and the market price is 24. The next year expected dividend is rupees 2 per share. So this is what, D0 or D1? This is the value of your D1. This is expected dividend. D0 is what? The D0 is dividend paid with the annual growth rate of 5%. So G is given to you. Flotation cost is given. P naught is given to you. Flotation cost F is given to you. The firm has the practice of paying all the earnings in the form of dividends. Corporate tax rate is 35%. Tax rate is given. Since the company is a multinational company, market value weights are preferred over the book value weights when calculating the weighted average cost of capital for the several reasons. Okay, fine, sir. He says when you are calculating KO or the weighted average cost of capital, you have to use the market value weights instead of book value weights. Fine. The company believes that the market values reflect the current market perception of the company's financial health and the future prospects. This is more relevant for calculating the cost of capital today as the investors base their decision on the current market conditions. Book values based on historical accounting principles may not accurately represent the true economic value of the company's capital components. Market values capture the actual cost that a company would incur if it were to raise new capital in the current market. Book values might not reflect the true cost of debt due to the factors like changes in interest rate or the credit worthiness. Similarly, the book value of the equity might not reflect the current investor expectations for the future dividends and the growth. Market values are readily available through stock prices and the market interest rates. Obtaining the accurate book values, especially for intangible assets, can be a more complex and time-consuming process. So this all is what? This all is just the story, right? The crux of this story is that when you have to calculate the this weighted average cost of capital, you have to use only the market value weights. Rest is all stories, sir, not relevant from your point of view, right? So in the case studies, you will always get certain stories in the case study, right? Nothing to worry. Being the finance manager of the company, you are required to provide the answer to the following questions to the top management. Calculate the cost of equity and choose the correct answer. From the following. So for KE, which formula will you apply, sir? Very simple. Dividend growth model, that is D1 divided by P0 plus growth rate, right? P0 minus flotation cost also. D1 is given to you because it is given. What is given? The expected dividend is 2 rupees. This is your D1. Price is given, flotation cost is given, and the growth rate is given to you. So what will you do? KE will be what? The KE will be 2 divided by price is 24 minus flotation cost of 4 plus growth rate of 5%, right? So let's see, 2 divided by 20 plus 0.05, that is 15%. Option B, KE calculated, right? So this will come to 15%. Whenever the growth rate is given, you have to apply what? You have to apply the dividend growth model. Clear with this? Fine, sir. Next they are asking for what is the cost of debt and choose the correct answer from the following. Now for cost of debt, for KD, you have to see whether it is a redeemable debenture or it is an irredeemable debenture. Now this one is a redeemable debenture, so we can use either the approximation method or we can use the YTM method. Here it is not specified that you have to do it by YTM method or the IRR method, so definitely we are going for the approximation method. What all information is required, sir, for KD? For KD, what will be your interest? For the calculation of KD, what all basic things are required? Interest rate is 9%. The interest is always to be calculated on face value, right? So what will be the value of I here? Value of I will be 9% on the face value, that is 9 rupees. And because interest is a tax deductible expense, so we have to take 35% tax also. 1 minus 0.35, right? So this value will be 5.85. What else do you need, sir? We need the net proceeds. So what will be the net proceeds here? Read it very carefully. What is given? 2% is the flotation cost. 10 years to maturity. The market price is 105. So I told you, whenever there is a market price and the net proceeds are given to you, we will prefer market price, right? Because it is not a new debenture, no? Yes, it is an old debenture. For an old debenture, we use what? For an old debenture, we always use the market price of the debenture. So 105. So for net proceeds, what you are going to use is 105 minus 2% of 105, right? Minus 2%, that comes to 102.9. What will be the redemption value? Anything given regarding the redemption value? He says, sir, redeemable at par. That means the redemption value is 100. I told you that even if the redemption value is not given in the question, we will always assume the redemption value will be equal to the face value, right? N is given as 10 years. Now you can calculate KD using approximation method. How will you calculate KD using approximation method, sir? Very simple. 5.85 plus redemption value 100 minus net proceeds 102.9 divided by N, that is 10, whole divided by 100 plus 102.9 divided by 2, right? So this is what you have to solve now for the calculation of KD, right? Okay, I will also try to solve. You also try to solve. 100 minus 102.9 divided by 10. That comes to 5.85 minus 0.29 divided by 100 plus 102.9 divided by 2, that comes to 101.45. So it will be 5.85 minus 0.29 divided by 101.45 multiplied by 100, that comes to 5.48%. 5.48%. Is their answer? Yes, sir. That is option C. Clear? So this is the value of your KD. Now small things you need to be very careful about. Redemption value, nothing is mentioned, will be equal to your face value. Net proceeds, if it is an old debenture, we always take what? The market price. The market price is given. On that you will take the flotation cost of 2%. Interest is always to be calculated on the face value. So face value is 100. We calculated 9% of 100. And for interest on debenture, please do not forget to take what? The tax impact. 35% is your tax rate. Clear? And nothing mentioned that you have to do it by YTM, so we do it by approximation. Methods are very simple. Now coming to the next part, what is the third MCQ? He says calculate the cost of preference shares and choose the correct answer from the following, that is KP. Now KP, again, whether it is redeemable or irredeemable, it is clearly mentioned that it is a redeemable, right? So what we need? Dividend. What is the rate of dividend on the preference share? The rate of dividend is 11%. So we'll write down the basic information now. Dividend will be 11%, always calculated on the face value, that is 11 rupees. Will you take the tax impact here? No, sir. The preference dividend is not a tax deductible expenditure. Always, 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 always remember, right? It is not a tax deductible expenditure. Okay, sir. What will be the net proceeds? Again, old preference here. The net proceed will be what? The market price minus the flotation cost of 3%, right? So 106. What will you take here? Okay, 106 minus 3% of 106. 106 minus 3%, that comes to 102.82. Redemption value, it is mentioned that redemption at par, N is what? N is given as 10 years. So again, they have not mentioned whether it is to be solved by YTM or approximation method. So we use approximation method, right? So we'll calculate here that 11 plus redemption value 100 minus net proceeds 102.82 divided by 10 whole divided by 100 plus 102.82 divided by 2, right? So 100 minus 102.82 divided by 10, that comes to 11 minus 0.282 whole divided by 100 plus 102.82 divided by 2, that comes to 101.41 multiplied by 100. So let's see what the answer comes out to be. Minus 0.282 divided by 101.41 multiplied by 100, that comes to 10.57%. Yes, option A, that is 10.57%. I hope this much is clear to you, right? Okay, sir. So we are done with the first three parts. Now we will be doing what? We will be calculating the market values and all. Let's see what is the next part. The next part says calculate VAT using the market value weights and choose the correct answer from the following. That means we will have to calculate the market values, isn't it? Yes, sir. Okay, for the calculation of VAT, what we will do? For the calculation of VAT, we always prepare the table, that is sources, amount, then we take weightage, weights, then the cost of capital, right? Then we have to take cost of capital and then we take weighted average cost of capital. So the sources are three sources only that we know. First is your equity share capital. Now, how will you calculate the amount? Amount means you have to calculate the market value. How will you calculate market value? The market price of the share is given as 24. What is the number of shares? That is 50,000 shares. So how will you calculate here? For equity share capital, 50,000 shares multiplied by 24 rupees per share. 50,000 multiplied by 24, that comes to 12 lakh rupees. Right? This is the market value. We have to solve it by market value ways. Next we have, that is preference share capital. Now, for preference share capital also, the market value is given to you. The market value is given as 106. Yes, 106. How many preference shares? That is 2250 preference shares multiplied by 106. 2250 multiplied by 106. So that comes to 2,38,500. Last we have is debt. For debt also, the market value, market price of debenture is given 105. Number of debentures is 2750. So here we'll take 2750 multiplied by 105. That comes to 2,88,750. What is this total comes out to be? Plus 2,38,500 plus 12 lakh, that comes to 17,27,250. Now we will calculate the weightage. That is 12 lakh divided by 17,27,250. That comes to 0.695. 0.695. Then we have 2,38,500 divided by 17,27,250. That comes to 0.138. Always take 3 decimals, right? If nothing is mentioned, 3 decimals is more than enough. 17,27,250. That comes to 0.167. 0.167. So this is for preference, sorry. This is for preference. Now, cost of capital. Sir, cost of capital you have calculated. For equity share capital, the cost of capital was 15%. So I'll take here 0.15. So I'll take here 0.15. For preference share, you have calculated it as 10.57%. Okay, so we'll take it as 0.1057. And for debt, you have calculated it as 5.48%, right? So we'll take it as 0.0548. Now multiply this, you will get your WACC. 0.695 multiplied by 0.15, that comes to 0.1042, 43 or 42, whatever you can take. 0.138 multiplied by 0.1057, that comes to 0.0146, and 0.167 multiplied by 0.0548, that comes to 0.0092, right? So take the total here, that comes to 0.1042 plus 0.0146 plus 0.009, wait. 2 plus 0.0146 plus 0.0092, that comes to 0.128. That means your KO, or the weighted average cost of capital, is 12.8%. Now let's see what answer we have here. Yes, 12.8% is the correct answer, right? So here, because of decimals, there might be a small difference. So in that case, you have to take the nearest answer. Right, you might be getting the answer 12.79, you might be getting the answer 12.77, right? In that case, 12.8, that is the nearest answer, because the difference might be due to what? The difference might be due to the decimals, right? If because of decimal there is a difference, nothing to worry about it. Okay, the fourth part is done. Let's come to the last MCQ. That what will be the current market price of the MNP's equity share? What do you have to calculate? Current market price. What is current market price? That is P0, right? If KE is 10%, expected dividend is 2 per share. This is your D1, and the growth rate is 5%. That is G from the following options. Now, how do you calculate KE? This is the Gordon's growth model. So KE is what? D1 divided by P0 plus G. Here, what we need to calculate? You need to calculate this P0, right? Can I take G here? Can I write it as KE minus G is equal to D1 divided by P0? Now I'll take P0 here. So I'll write P0 is equal to D1 divided by KE minus G. right? So D1 you have, that is 2 divided by KE is given, that is 0.10 minus 0.05, right? So 2 divided by 0.05 into 40 rupees per share, that will be your fifth one. With that, we are done with the case study on cost of capital. Now, this is a very important case study. These kind of case studies, definitely the institute has been asking in the examination. Please mark it as important. This case study, you must revise it just before the examination also, right? So with this, the case study on the cost of capital is done. Next case study is again a very good case study, that is on the chapter capital structure, right? But before moving on to the next case study, please revise this case study, whatever we have done, and focus on the small things where you might commit the mistake, right? The small thing, the small areas, what is to be calculated on what, interest to be calculated, face value, tax to be taken, net proceeds, market value to be taken, and all those small things, please fix it here, fix it here, fix it here. That is going to be the key while you're attempting your paper, right? Okay, so with this, we are done with cost of capital.